The following is a presentation of TFNN. The Global Market Pulse. With your host, John Logan. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, John Logan.
Hi, guys. Welcome to the show. Wednesday night here in Asia, Wednesday morning in the U.S., and going to get right into it. A couple of things today. One of them, FOMC meeting minutes. Out at 2 o'clock this afternoon, but I guess, just to kind of get right into, what I feel is the main pressure point of what's going on globally right now is the Japanese yen. We've increased the leverage on this trade, devaluation of the yen. I've got, this chart. Again, this is kind of the opposite of what the devaluation chart should look like. We're climbing higher on this. We started at around, just to do a little bit of history lesson here, we started talking about this as kind of, my favorite situation, 101.33, not to beat this to death from the past, but again, it really hasn't really caused a lot of technical damage for you to kind of, it caused me to want to kind of retrench in here about 105.44, but, 117.60, 61 is where we're trading right now on the yen, on, the inverse of the devaluation of the yen. And if you're trading the futures, you're actually kind of trading this down. If you're doing a Forex trade, you're trading it the other way. But you know what? Another reason I'm talking about this today is I heard something through some channels coming through Japan that, I'm kind of, I guess, on the same time zone as Tokyo right now. It was actually, it's kind of shattered my mind a little bit to hear this comment that the Japanese central government, the pairing of what we would call the Fed over there, the Bank of Japan. Can you believe that they said this? They said that they're okay with their balance sheet being almost as high as the GDP of the country. Can you really grasp what that means? I mean, that means that the Japanese government is okay. Well, their version of the Fed is okay with holding enough paper in-house to equal their gross domestic product. I mean, we enabled this. I mean, the United States enabled this way of thinking, and now the rest of the world is going to take it for a spin. And we do not know ourselves. This was an experiment, and everybody called it an experiment. And now the rest of the world is like, oh, I guess the experiment worked out. But I mean, we don't know if it worked out. I mean, that's the sad thing. So having the Japanese go to that level of, in my opinion, of insanity, is one of the things that is causing the yen to cave in, and I don't think the end is in sight here. Normally, when you have a rally like this, you got to start taking shots on the short side at some point, but there's so much overhanging fundamental reasons that this thing is probably going to get, continue to get crushed. I don't know if that's in order at this stage. Of course, there's going to be little news events that they come out with to cause it to move the other direction so they can actually get out of some of their positions they were in, or maybe retool in one way or the other. And you always got to be prepared for those. Just like, this happened. Look at the weekly back here. I mean, that was a pretty severe pullback. We had about more than 500 pips in less than 2 weeks that happened on the downside there. But then we, caught that bid again and rallied significantly up. But I really don't see anything standing in the way of still staying on the side of the fence where the Japanese yen will get devalued. I mean, 125, in my opinion, may be in order now. And, we were, looking back in time, let me pull up the weekly here really quick. I don't have this going back as far, but this currency was at 80 not too long ago, and now we're approaching 120. So I think we've got a little bit ways to go on this. Australians have really come out. They've trade agreement with China. Let's go ahead and put our toe in the water. Why not India? So that's kind of what the Aussies are going in and having these free trade agreements with China solidified. Now they're trying to do the same thing with India. In my opinion, that's actually, less taxes, things like that. So we always talk about the Australian dollar. We don't think this is finished on the downside. So just the hint of them talking on that level is going to cause this fundamentally to kind of devalue a little bit more against the U.S. dollar. And we've used this leverage point here at 87.26. So above there, I was kind of saying, Uncle, maybe this is not the trade for me at this stage on the short side the past couple of days. But as soon as we get back below that inflection point, I'm able to kind of get back in the game. If we had reached the higher inflection point of this fair auction, 88.74, I'd been a seller up there also. But kind of in here is kind of the so-called fair auction, and I don't really, on an intermediate basis, I'm not really impressed with any action here. It could go both ways. So now it seems that we've got some confirmations on the Aussie again, and we've got below the weekly numbers this week again. And those weekly numbers, 87.19, coupled with the dailies that I just mentioned at 87.26. So now that we've kind of broken down below there 2 time frames, that's good news. And as you look at the scanner, if you pull up the Aussie dollar, you're going to get those inflection points put to you very quick in a nice manner with some of the cells that we have on that particular product. So here's the 240, nothing in the way there. So I think we've got some clear sailing on the Aussie on the downside here, and I think at this stage we could start seeing those recent lows, which are around 85.41. So that's what I'm looking for on the Australian dollar. All right, so the other thing I wanted to talk about today is the DAX, and we're going to leave some of these currencies alone. The ruble, there's, like me and Eddie talked about yesterday or the day before, there's no end in sight on this scene either. And these profiles well below price action really are very bullish patterns. So we want to just keep in mind that the ruble may hit 50 at some point and even higher. But let's take a look at the DAX really quick now that we've kind of covered some of the currencies. And the 93.06 coupled with these recent numbers, which were, again, these are 93.20. Those were big inflection points, remembering that the most, previous profiles, kind of like an exponential moving average, those numbers are going to have some bearing on what's going on. So as we kind of came down here and test daily back up, was the previous okay to be long, not okay to. Okay. Sorry about that, guys. Had a little blip in our connection here. And I'm going to have to see if I can reconnect it then. So that's my take on, as this populates, that's my take on the DAX. We're going to have to just kind of eliminate the short trade right now. And the reason being, one of them is on the DAX, and this is kind of why I started this, is on the market breadth on some of the things I've been looking at and we've been taking a look at. And this is our admin version. As you can see, we're very, very positive on breadth, on profile breadth, that is, on the Eurostoxx 50, which has some of the DAX components in it also. And we've done some studies on the DAX, and we're looking at the DAX. We just don't have the DAX components up here for market breadth right now. And again, I'm just showing you some of the raw numbers, which are breadth positive. And if you look at this on a long term, I'll just show you the intermediate right now. This is, God, come on. Well, I may be having worse connection problems than I thought I was. Okay, let's not look at the chart. Let's just look at the raw numbers. The breadth's been positive on this Eurostoxx 50 for a while. If you've got the scanner, you've been seeing that. And for some reason, my connection won't let my charts come up here. But as we look at the S&Ps, a similar situation here, and the DAX is kind of obviously the weaker relative trade versus these U.S. indices. But as I look at some of the they're coming up now on the S&P. Okay, I'm just going to eliminate the inside here. And as I look at these crossovers, we've been, we crossed back over around October 17th to October 20th that weekend. And we've been breadth positive since then, and that was about a month ago. And as you can see, we had the crossovers happen on the 19th, the 22nd on our dailies, breadth negative there. And you know what happened between the 19th and the 17th of 19th of September and the 17th of October. So I'm showing you the admin version here that we can kind of track the charts, and the Eurostoxx 50 now is kind of in the same go-go mode. And that kind of lets me know that the DAX is still in breadth positive situation as we look at the DAX with some of our other numbers. Okay. While we're talking about the indices, I want to just kind of take a look at the S&P since we just looked at the breadth. And it's been hard to argue for me against going long since that crossover around the 17th. Am I having problems with the CME or E-signal? Okay, here we go. Come on, charts. Okay, this is a CME problem. Oh, here we go. Okay. So, again, the numbers to pay attention to, we've kind of stated these past couple of days, 2038, let's call it 2039. That's going to be your first 10 of any kind of breakback downs into the fair auction. This is our daily. But again, technical breakdowns will happen between 14 and 19. We're going to be right back, folks. Hang in there. And apologize for a couple of technical issues we've already had today. We'll be right back.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, guys. Welcome back to the show. Apologize for some of the technical difficulties we have. I think we've got them sorted out now. We took a look at the network here. Take a look at the Nikkei right now, and we talked the other day about the disconnect that's probably going to widen. I mean, we talked about spreads in general. We talked about the S&P equals Dow plus NASDAQ so-called spread. If you're watching that show, and how sometimes these things kind of get out of they're in tandem, and then they break apart, and then they really break apart. Well, and we talked about kind of weighing monetarily equally on both sides of the math equation. So, a lot of times these spreads, you're looking at corn and soybeans, right? Or that's not a good one. Corn and wheat. You're always trying to balance the monetary values of those things on each side of the equal sign. So, for instance, if corn, I'm just going to pick some numbers. If corn is trading $4 a bushel and wheat's trading $6 a bushel, you don't really trade, in the spread. You can, but a lot of times you want to try to balance the equation and trade 3 corn to 2 wheat or whatever that is in that equation. And we talked about balancing the situation and monetarily at the yen and the Nikkei and trying to play that so-called spread now that you got the Japanese economic situation being kind of forefront and apparent and showing its hand, and the words recessions are being used. And that's giving fuel to the yen now in general to get devalued more. You want to kind of keep that in mind. I think this is a decent trade. You don't want to pile huge money into new ideas. You always kind of want to put your toe in the water and kind of feel it out and get used to the situation first. So please don't take any of my words at face value that you should put your retirement fund into it. But sometimes traders, again, we talked about this before, just get addicted to one particular market. And I think you just, in my opinion, might need to look around sometimes, because some of these currency trades these days, folks, have really just been make your whole year type trades and just sit back. I know traders that have retired recently off this yen move. I mean, they just said they can't get any better than that, and they've been locked and loaded since 100 on that thing. So, am I being heard? Okay, somebody said they can't hear me. So that's the situation with the Nikkei yen. We talked a little bit about the S&Ps. We talked a little bit about the DAX. I want to talk a little bit more about crude oil because we kind of just brushed on this the other day. Where are we at with crude oil here? Well, there we go. Okay. Thanks, Mark. Crude oil, and HOF5. I'm trying to pull that up. Heating oil, because I know you guys were kind of looking at that. Let's see here. I think I have that wrong. Let me just put a space in here. I want to talk about crude oil, and then there it goes, January heating oil. Well, let's look at crude oil first. God, man, somebody's messed my screen up here. Oof. All right, so December crude oil here. Eddie was on, and we were kind of throwing out some different inflection points, and, crude oil's kind of been in a really bad state, trending down for a while here. The only thing that's going to, just to sum it up before we talk about heating oil, the only thing that's going to prove it to me that we're just not probably going to, we could have some technical damage, and then that would run some people out of town on the short side, would to really kind of on an intermediate basis get back above 79.19. That's going to kind of, have me saying, Uncle, I'm going to pick a, pretty decent battle around 79.19 and try to stay with this on the way down, as I would at 75.89. But again, if we get above 79.19, I don't think I made that very clear the other day, so I'm just going to say it that would kind of put things in a different light for me on crude oil for a while, and I'd want to wait until we got back down into a fair auction again, whether it's a new one or that same existing one, depending on how long it will stay in force. Taking a look at heating oil January, since I saw some guys talking about it and somebody asked me to take a look at it. Let's see, what are we at this morning here? Because sometimes these weekly, 239 rounded off. All right, so that's reflecting current prices. Technically speaking, I don't follow crude oil. I don't follow heating oil. Obviously, on a long-term basis, it's okay to be short, not okay to be long when we got below this most recent profile. But let's just keep digging and dig a little deeper here. And let's see that 242, 243, that inflection point. And I think we have this on the scanner. Let me just make sure we do. We do not. Michael, can you put heating oil on the scanner? Okay, so that'll be up by tomorrow, guys. I thought we had that as one of the default. Damn, I'm kind of a miss right there on that. But 243 inflection point on the bottom of our daily, and on the weekly 245. So that kind of DMZ in there between. Man, I've lost my mind this morning. 243 rounded off and 246 rounded off. That's going to be kind of the upper limit resistance level that I'd probably want to continue to short this, and hopefully we would get back up into that area for a little bit of a ripe opportunity. Remember, we kind of closed below and haven't really retested this area yet. That span that we just spoke of. So I would kind of be, hoping that we would move back up, let the market come to us, and then put stops above there, oriented around those two inflection points. Here's the only thing that really kind of puts it in a little bit different light for me is heating oil has made lower lows, and with some other things that we look at, and we look at a lot of different things we don't show on the screen in some of the talks that we give, but just to kind of keep it simple and tight, this is really kind of a divergent situation here that's happened. When we made lower lows on price action and higher lows on our navigator, Eddie and I look at I ratio and a couple other indicators that aren't really factored into our scanner. But, I think the overhanging, bearishness of crude in general, which is a precursor to make heating oil, may keep this thing down, and then this would kind of settle out, and we just have to wait and see on that. I'm not a big fan of going long heating oil, but if we get above those 2 inflection points I spoke of, I think it's not a terrible opportunity. You're just going to be in for a noisy ride up into this fair auction up until 250, 290. So that's kind of the way I'm looking at heating oil. Again, things on the lows go lower. These things don't have to reverse, and the situation with crude oil kind of puts a little bit more fundamental heaviness on this concept than I normally would look at with pure technicals. Well, if you're a big fan of bottom picking heating oil, you may be very, very right. And I'm looking at some of the comments in the den. You may be extremely right. And, I just think you're going to have – it's okay to think that way, but I think you might even have a better chance to add to that bottom picking idea if we can cross some of those borders right above. So, again, we used to have big prop groups in Chicago, and I probably told this story before, but, one of the marks of a really good trader was that we noticed, and we were kind of proud to see that happen when it happened, is they would add to winning positions and not add to losing positions. So that means that, dollar cost, I don't know if you're doing this or not, but like dollar cost averaging really has taken people out in body bags, especially in 2008 in the stock world. So, it's kind of the opposite of that, what we tried to get people to do up there, which was, if you kind of play around on the shorter term time frames and you kind of start bracing yourself, I guess, like kind of somewhat like you're talking about right now, that's okay. Like kind of get your toe in the water. That's never a bad thing. But if you can cross some borders in the right direction, you can start adding to a winning position and kind of, keep the stops in order as you move up or as the position goes in your favor. And I know that's opposite from doubling down, but, stops around those type of situations that I just spoke of are paramount. And, that's when you sometimes make your whole year because, in something like the yen trade, we talked about, just for example, 101.33, Tom even asked, I said that was my favorite trade on the books. I've been saying it for a while. But, what happened? We went up to like 110, pulled back to 105. And, to me, it was still a winning trade. And therefore found in fact, I would call it lucky opportunity that it did pull back into that 105. And then we're able to add to those positions because, there was a lot of things in its favor to continue to go up or get devalued. So that's kind of the same concept here. I've talked so much about this. I know you're tired of hearing it, but crossing some borders and get some deeper convictions might be in order on something like that. I wouldn't try to load the boat down here, if you will. Gold. This is kind of, with the dollar, rallying and, gold being priced in dollars, I like the way this is acting now, and I really loved it above 1180 like we talked about the other day. I think we're going to crowd 1200, that whole number, and actually explode. That's my feelings on gold. And I think, even though we've touched this 1206 area, we don't really want to back off of it too much. This is our weekly unfair lows. I'd love to see it get above. I'd love to see it kind of compress here a little bit and scare some shorts. I mean, that if I was short and this thing started, as Tom would say, building cause down here and start, kind of rotating between these daily unfair highs and weekly unfair lows, I would get a little nervous. And that's kind of what you want to happen here. You want some people to start covering. And I think if we can get back into the weekly fair auction, then we're going to start possibly seeing again that 1251 number up top. Okay, let's take a look at silver really quick because this has been something that's been a little bit deflated relative to gold. It's just going to, for me, it's just going to have to. We talked about this quite a bit. It's going to have to get above 1641 for me to start really loving silver and thinking that some shorts are going to have to start covering above there. And then I think that's a really good breakout opportunity on silver in general. We haven't talked a lot about stocks today because I still think that some of these currency plays are just they're very rare. What's going on right now, and you've got to, like I said, some of the traders that I know have really almost retired. Some of them have retired off some of the trades that they've been in lately, and just now it's a free trade, and they're just sitting on the sidelines. You don't get these historic moves this often where central governments or central banks are behind these things. And I think that some of the futures and some of the currencies are probably where traders should really be looking the most right now. The S&Ps, obviously, that's been a pretty serious march north. And this is what keeps me a little more sane looking at these upsides on the S&Ps, is looking at the breadth positive situations that we've come out with. And if you want to take a spin on this and take a look at these numbers in a real easy to read speedometer fashion, we've got this available on the TFNN homepage. You're able to look at some of the usual suspects of the futures and commodities world and ETFs, and then also get rid of those. You can pull up the S&P 500 and quite a few other instruments. Do some filtering and try to get some good high probability trading ideas out of the way before the market opens every day. So right now, in the last segment, I'm going to use the scanner a little bit, but right now I want to cover one more thing before we go to the last break. And what do you do with treasuries right now as these S&Ps seem to keep marching forward? Obviously, we kind of got up into the top of our fair auction on the daily, never closed above. We talked about needing a close above. That's kind of, I'm looking at the treasuries on a long-term trade right now, and my stops are kind of a little bit below 126. This latest rally for a full handle on the 10-year was pretty nice, and I think you should always take profits at the other side of a fair auction to some degree at some of your position. But right now we're back in kind of churn city. And if the S&P's ever pull back, I think this thing's just going to explode. But that's a wait and see. We've got to wait that out. Look at the market breadth on the S&P to give us some guidance. We'll be right back, guys.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. When you first learn something in life, you have the most questions as you begin to apply that knowledge, which is why Steve Rhodes came up with the idea for his 7-week trading program. It all begins Saturday, November 22nd, when Steve Rhodes will host a live 3-hour morning workshop where he'll teach his attendees the precise methodology he uses when placing trades. You'll then receive 6 weekly updates each Monday morning discussing the possible alerts currently setting up in the market. Steve will then bring everyone back together for a final 3-hour live workshop Friday, January 9th, where he'll discuss the methodology that went into each of the 6 weekly updates, making sure that you're confident in applying what you've learned so that you can begin navigating the market on your own. You can sign up right now for this entire 7-week trading program with Steve Rhodes for a one-time payment of only $395. If you're a Mastering Probability subscriber, then you can save an extra $100 off that price. For all the details, visit the front page of TFNN.com right now.
Catch Steve Rhodes as he teaches techniques on technical analysis using pattern recognition, celestial charting, Fibonacci, and other tools. The Trader's Edge, next on TFNN.
Hi guys, welcome back to the show. What I was showing here, I was just doing a little filter on the scanner. I got the S&P 500, and I was just kind of looking for bottoms, things that are lining up on the bottom of their profiles, and I was looking at Wells Fargo, WFC, because I noticed that it also had a top formation on my weekly. So what I want to do, and there's one on Franklin Resources like that, and there's one with daily and 240 here, HP, Homework and Payne. Vertex Pharmaceuticals, Mattel, but let's just focus on WFC because I like these long-term inflection points lining up with each other, as well as Franklin Resources. Here's Wells Fargo, and sometimes I glance at Yahoo just to kind of see what they're kind of throwing out there, and they had a question. What are the least favorite banks or the most customer dissatisfaction? And I kind of answered it before I looked at it. I was like, well, it has to be Wells Fargo or Bank of America. And they were the 2 correct answers, by the way. They have the worst customer service. And if you guys have banked for a while and you've ever kind of had the unfortunate, maybe some of you don't feel that way, but it's very frustrating to deal with a large entity that nobody seems to really care that much anymore. I like the personal banking is kind of nice at these smaller banks, but it's just amazing how they've gotten disconnected from their customer base on the retail side. Okay, so the unfair high is 53.06 on the weekly, and we've got a little bit of a disconnect here in the divergence of new highs on Wells Fargo and kind of lower highs on Navigator. That's the first thing I'm noticing. And as we look at the daily, in the long term, that's what I'm noticing and that's what I'm seeing. But we've also got an inflection point here at 53.32. So we've got a DMZ, if you will, like 53, 53.30, that general area. And price action right now, pre-market, is 53.20. So the cool thing is we're kind of sitting there right in an area that we want to see it get away from one way or the other. Now, you could look at this as like, okay, made new highs, coming back to support, and let's get on the launching pad. Just because of this divergence down here, and it has some relative weakness to the market right now. The market's kind of climbed higher and it's kind of been languishing down here with the financials, so to speak. I'd like to see this close below 53 and then be able to use kind of 53 as a leverage point to move even lower. And, this pre-market right now in WFC, we've been as low as 52.80, I guess, yesterday. But, I'd like to see this close below, and then I just put my stops above 53. And I'm basing this really not on this alone, but it's given me the idea that we've got a great dual time frame inflection point lineup situation that is one of the kind of my favorite trades. It's a relative strength trade and a trade where we could go back down and explore the entire fair auction, which we usually do, I might add. And we got a new box and we haven't even hardly touched it. So this is kind of something that puts it on my radar screen, and something that's we're going to actually pay attention to this as we move forward. Now, that being said, we're not going to get a lot of help from the S&Ps right now turning this down in some kind of beta fashion, because the breadth is still positive and it hasn't even remotely started turning around or showing any forecasting to turn negative. Guys, thanks for joining us today and getting through the technical problems with me. Steve Rhodes is next, Trader's Edge, and you'll thoroughly enjoy listening to him. He knows what he's talking about, folks. Thanks very much.